Welcome to this CNBC Africa special. I'm Chris Bishop. Well, it's the big story in business that everyone's talking about today. South African bank Absa is going to complete its final divorce after an 11-year relationship with the British bank Barclays. What does it mean? How is it going to change the way that the company is going to do banking, and what are the ramifications for business? Now, with me on the line, I've got Absa CEO Daniel Mminele, who's here to tell us exactly what is going to happen. So, according to our research here, Barclays reduced its exposure to Absa to 14.9% back in 2017. Just tell us how the final throes of this relationship are going to go.
Good morning, Chris, and good morning to the viewers. As you correctly indicated, this particular point in time, from an initial stake of about 55.5%, which, as part of Absa acquiring the African business of Absa, then went up to a peak of about 62.3% or so. It is now at the level of 14.9%, which makes Barclays still our largest shareholder. And clearly, the plans around why they are comfortable with and where that stake may end up or remain is probably questions that are best addressed to them.
What difference is all of this going to make to the way that Absa operates as a bank on the continent?
I mean, obviously, the first thing, Chris, is to highlight just what a great achievement this has been, because this has been one of the most complex corporate programs of its kind, certainly unparalleled on the continent in terms of this separation. So what had happened is that when Barclays acquired Absa in 2005, there was an ensuing period during which Absa was integrated into Barclays systems, processes, and policies, which this process was basically reversing. And part of that was that essentially Absa was not operating as an independent entity, but as an international sort of offshoot of a UK bank. So the big issue around the separation now is that it opens up the way for us to be an independent African financial services group that can now chart its way forward in terms of taking independently decisions that are in the best interest of our clients and our customers and our other stakeholders across all the markets that we operate in Africa.
Now, Mr. Mminele, you've been quoted as saying that the group will now focus on preserving cash rather than growing your market share because of the upheaval of COVID-19. What faint signs of recovery, if any, are you seeing in the economy right now? Because it's a lot of concern to a lot of people on the continent right now.
Well, Chris, you're right. I mean, obviously, many businesses across the globe were severely affected by the onset of COVID-19. In our case, and like many others, we have obviously adopted a defensive pose, and I've said that the critical issue now is to preserve capital and to ensure that we've got sufficient liquidity buffers. The issue around recoveries and green shoots, probably too early to tell, but I guess what one can say is that where we have seen economies starting to be opened up, some activity has returned to the markets and the economies. And certainly if you look at global financial markets and the way they've been performing recently, they seem to be taking a greater comfort in economic activity, returning somewhat faster than may have been anticipated. But at this point in time, while we're seeing encouraging signs as and when economies are progressively being opened up, it remains uncertain how quickly we might see a growth being restored to more acceptable levels. Certainly the various forecasts that we have seen recently, and the World Bank was the latest to put out its forecast, obviously point to a very, very dire growth situation, at least for this year. But we are indeed starting to see signs of those that have progressed a little bit further in managing the pandemic and are in a position to start opening up their economies, that they are indeed starting to see activity coming back.
Now, here on CNBC Africa, we've been talking to a lot of banks who've been saying they've been suffering severe losses and write-downs because of COVID-19. How long, in your case of the bank, do you think it's going to take the bank to recover from the lack of economic activity that's been costing you so much?
I mean, some economies, and certainly if we look at sort of our largest market being South Africa, with the expectations of the contraction, the very deep contraction that we will see this year, it'll take multiple years to get back to the pre-COVID sort of levels that we would have seen. And you're right. I mean, in this environment, many of the banks and the lenders will be focusing on cost management. They'll be trying to manage their impairments. They'll be making sure that their collection processes are up to scratch to make sure that they can re-emerge from this crisis as quickly and as unscathed as possible.
So in this very difficult economic climate you're facing, how likely is it that there might be consolidation of some of the banks here in South Africa in the near future?
I guess another one which may be premature to sort of be conclusive about, but what is a fact is that some of the smaller, some of the weaker banks will have faced much more severe challenges in this environment, as opposed to sort of larger institutions such as ours, which went into this crisis with relatively strong capital buffers and good liquidity positions. But those institutions that might find themselves a little bit weaker may well become targets in terms of consolidations that could happen. But as I said, it may be too early to tell, but some would have been challenged more than others and could be vulnerable to be taken over.
And what about the international markets as well in terms of borrowing? Even before COVID-19, the economy here in South Africa, we had a downgrade. Already it wasn't in great shape. Bearing in mind there's a lot of perceived risk amongst international financiers, how much more expensive do you think borrowing might become in the next year or so?
Well, again, we'll see. Obviously, what happened as part of the crisis, we have seen many governments and many central banks implementing policies that sort of eased financing conditions globally, and interest rates were reduced quite dramatically. So that should provide some relief. But at the end of the day, it is going to be the strength of the credit, the quality of the borrowers that will differentiate in terms of how the cost of capital might evolve. But critically, of course, as well, Chris, is then the other side of it, which is going to be an important part of the equation, how you use that capital, how that gets allocated to achieve the kind of returns that will help you service any additional debt that you may need to take on.
What differences in the direction of capital do you think we're likely to see in a post-COVID-19 world?
Sorry, just repeat the question. I'm not quite sure what you're asking.
Sorry, how do you think capital could be redirected in this new normal that everybody's talking about after, or one day, hopefully, COVID-19?
I think that will be a function, Chris, of how people assess their respective operating environments to have changed. Clearly, some of the fundamental structural changes that have been brought about by COVID will lead to different customer preferences. They will lead to a different distribution channels that may need to be looked at. And it's going to be on the basis of that. That's what's going to inform how best one direct capital in terms of sectors that are likely to perform better and be better suited to a new world that we're going into. What is, of course, pretty clear as we sit here is that the whole issue around digital innovation and digitalization is certainly an area to which we will see much more investment and much more capital flowing, issues that have to do with perfecting sort of remote working environments and the issues that would come with some of the investments that would be required. Those are the kind of areas of the economy that are likely to attract capital more than others that may have been more damaged through the COVID experience.
Now, earlier this week, I was reading a story about concerns of the Bank of England. Like in this country, they've facilitated a lot of loans to struggling companies, trying to bail them out and help them survive in the UK through this COVID-19 crisis. Now, I know a lot of the banks here have done the same thing. Bearing in mind that more than half of the companies in South Africa alone are expected to go to the wall in the next few months, how concerned are you that you're not going to get your money back?
Well, as I indicated earlier, a lot of focus will have to go into our collection processes, and we have to go into watching very carefully how we manage impairments. But there is no question that this is going to be a challenging environment that we're going into. But for us, it was important to make sure that we let our customers know that we are close to them, that those that are strong and have found themselves in a difficult position solely because of COVID, they've been getting the message from us that we will be a reliable partner even in difficult times. But it's got to be important to be very careful in terms of managing impairments and delinquencies.
And also your cost base at Absa. There can't be a company in the land that's not looking at their cost base at the moment. How might you rationalize things as the economy and as the company starts to recover from COVID-19?
Cost management is going to be a very important component of how we come out of this crisis and how we succeed going forward. And that is a subject that continuously receives attention. We look at the various components of our cost base that can be optimized. And a lot of it, of course, will depend on how we analyze what the impact of the crisis overall would be, and which at the moment, as you know, things are very fluid. We operate under conditions of heightened uncertainty, but continuously reviewing and making sure that your cost management processes are up to scratch is going to be one of the differentiators going forward.
I'll say there's a lot of talk of doom and gloom around in the economy at the moment. You've been studying it very, very carefully indeed, as is your job. What can you give business viewers out there in terms of a little bit of hope for the remainder of the year?
Look, I mean, we've got to stick to each other. We've got to take care of ourselves. We've got to show human solidarity, and we will get through this crisis. It's a big challenge, but it's not insurmountable. And as I said earlier on, there are signs, as and when the economy gets opened up, that activity is returning. And so the key issue is to not compromise on the gains that we have made with regard to the health protocols and issues that potentially could provide setbacks going forward. But I think we shouldn't lose hope. And it's just a question of making sure that we stay close to our customers as a business, that we talk to our peers, that we engage with our regulators and find common solutions to what clearly are common problems, in fact, on a global scale. But I don't think it should be all doom and gloom. The challenges are severe, but we'll get through this through collaboration and, as I say, supporting each other.
Well, certainly a lot of hard work ahead for everybody in the economy. Thank you very much indeed for your time and insights. That was Absa CEO Daniel Mminele speaking to us live here at CNBC Africa, not only about his company's impending separation from the British bank Barclays, but also a taste of what's going on in the economy and a look at how the bank is going to approach that. I'm afraid that's all we've got time for on this CNBC Africa special. From me, Chris Bishop, it's goodbye.